In this video, we'll be going over the IRS Interactive Tax Assistant tool that helps taxpayers determine whether or not they can claim a tax credit for paying taxes to a foreign country. So for the purpose of the foreign tax credit, a foreign country includes any foreign state besides a sanctioned country, so any foreign state, political subdivisions of that foreign state, and U.S. possessions. U.S. possessions include Puerto Rico and some American Samoa. So the following countries are considered sanctioned countries: Iran, North Korea, Sudan, and Syria. So in most cases, only foreign income taxes qualify for the foreign tax credit. There are other taxes such as value-added tax or VAT, sales tax, or property tax that aren't eligible for a tax credit but might be eligible for an itemized deduction. In order to go through this tax assistant tool, you'll need the types of income that you received and information on where or how that income was earned. According to the IRS, this tool should take about 10 minutes to go through, so let's begin. First, we're going to select the most recent tax year, which is 2023. As a reminder, any text that's highlighted in blue means that you can click on it, and the IRS normally opens up a separate page where you can get more information. This particular link seems to not be working, so we'll try it at a later time with a different link. So let's try this one. In this case, I selected the link for a related person, and the IRS defines related persons as the following, and then gives you the reference where you can find additional information. So in 2023, did you pay or accrue creditable foreign income taxes that you actually or constructively received? So constructive receipt means that the income is credited to your account or set apart so that you have access to it. You don't need to actually have physical possession of it. You just need to be able to have access to that. So let's just say yes. So here are all the different items that you might have received income for. So let's just select all of them and see where it goes. Fringe benefits, wages, salary, interest, dividends, rental income, sure, you name it all. Except for other income. We're not going to go into that depth, but we'll walk through a lot of these questions and we'll see where they end up. So, is the payer of interest located in a foreign country? We'll say that person is. Was the payer of dividends a foreign corporation or a U.S. corporation paying foreign source dividends? Yes. What's the source of your pension income? So it could be distributions based on your contributions, it could be investment earnings, or it could be both. So let's just say both. Did you earn a pension based on services you performed in a foreign country? Sure. Is your rental property in a foreign country? Sure. Do you receive royalties from a patent, copyrights, etc. when the property is being used in a foreign country? Sure. Is the real property that you sold located in a foreign country? Yes. Is the pension trust located in a foreign country? Yes. Were the services that you performed for wage and salary performed in a foreign country? Yes. So your fringe benefits will be a little bit more selective here. We'll stick to housing and education. We didn't receive any of these other reimbursements. So is your principal place of work in a foreign country? Yes. Do you have business income from personal services? We'll say yes to that and no to everything else. So were your personal services performed in a foreign country? Yes. So you're eligible to claim the foreign tax credit. And then it goes on to say that you can claim the foreign tax credit based on all of these different sources of income. So in order to claim the tax credit, you would need to file at least one form 1116, which is the foreign tax credit. Uh, you attach it to your form 1040 or 1040 SR, and then you can claim that foreign tax credit. There are certain instances where you may be able to claim a foreign tax credit without filing Form 1116. We'll attach a link to the article that goes into that in a little bit more depth, just so that you can understand those exceptions. And then also, if you're not able to use the full amount of foreign taxes paid in the current tax year, you can carry it back 1 year or carry it forward 10 years. The foreign taxes that you paid on income that's excluded for gross income is not eligible for either the foreign tax credit, and it's not eligible to be deducted on Schedule A of your tax return. So that's it in a nutshell for this form. The last thing I'll go over is this review screen. In this case, we selected quite a few options, but what I advise people to do in each of these scenarios is to print a copy of the review screen, which you can do using this print button right there at the bottom. You print it out and you go over it with just line by line with a pen and piece of paper. And what you're looking for is any mistakes that you made. Because we went through this form pretty quickly, you can imagine a person going through a form and clicking the wrong button and then having to rely on that information with their tax return. So what you're looking for in this review screen is just to slow it down and make sure that everything that you stated in here reflects the truth as you know it. And then once you're satisfied, you can use this as information for your tax return. Simply keep it with your tax records. And then that way, if you're ever asked by the IRS to take another look at your tax return, you have it available for reference. As a general rule, the IRS doesn't audit tax returns in the same tax year. It's usually 1 to 2 years later. So odds are pretty high if you don't keep this in your tax records, you're going to forget a lot of the information you put on your tax return. And because this is not tax or legal advice, you have to be very careful that you answered the questions correctly, so that you don't fall afoul of the tax rules. And you want to make sure that if you make an honest mistake, that's one thing. Most of the time, an honest mistake ends up in a recalculation of the tax. You pay the difference plus interest on that difference. But what you're looking to avoid is any accuracy related penalty, any negligence penalty, any indication to the IRS examiner that you didn't take this seriously. So an honest mistake, that's one thing. You're looking to avoid penalties that can be imposed on top of that honest mistake. And a good way to do that is, if you're ever relying on this tax assistant tool, print a copy, keep it in your tax records for reference. So that's all we have for this article. There are a couple of mentions to some forms. We'll put links in the show notes to both the article and the videos that we've produced on those. And if you have any questions, comments, please hit me up in the comment section. And if there's a video that you would like me to produce in the future, please hit us up in the comments on that. So that's all we have for now. Thank you very much and have a great day.